If you turn 73 this year, there's a date on your calendar you probably don't know about. Miss it, and the IRS can take 25% of money that was supposed to be yours. Not a fine, not a fee. A quarter of your own retirement savings, gone. Just for being late. And here's the part that makes it so dangerous. Most people don't even know this rule exists until the letter shows up. This is about required minimum distributions, or RMDs. If you have a traditional IRA, a 401k, or almost any retirement account that isn't a Roth, the government eventually wants its cut of the taxes you deferred all those years. And they don't wait forever. There's a specific age when you're required to start pulling money out, whether you need it or not. Get the timing wrong, or forget entirely, and the penalty is brutal. I'm going to walk you through exactly what this rule is, who it applies to, the exact deadlines you need to circle in red, and how to avoid the 25% hit completely. I'll also show you a mistake that catches even financially careful people off guard in their very first year. Stick with me, because the trickiest part of this whole system isn't the first deadline, it's the second one. And that's the one that trips people up the most. Let's start with the basics, because you need to understand who this actually affects. If you have money sitting in a traditional IRA, a 401k, a 403b, or similar retirement accounts, the government let you delay paying taxes on that money for years. That was the deal. You didn't pay taxes when you put the money in. But that deal has an expiration date. Once you hit a certain age, the IRS says it's time to start withdrawing and paying taxes on what you take out. For most people turning 73 in 2026, this is your year. The age was recently raised from 72, so if you've heard an older relative talk about this rule, the number might be different from what applies to you now. That's exactly why so many people get confused. The rule changed, and a lot of outdated information is still floating around from friends, family, and even old financial articles. Now, here's the first deadline, and this is important. Your very first required withdrawal doesn't have to happen by December 31st of the year you turn 73. You actually get an extension. You have until April 1st of the following year to take that first withdrawal. This sounds like a gift, and in some ways it is. But this is also where the trap sets in, and I'll explain why in a moment. Let's talk about what actually happens if you miss this. The penalty used to be a staggering 50% of the amount you should have withdrawn. That's right, half. A few years ago, the government reduced it to 25%, which sounds like relief, but let's be honest, 25% of your retirement money disappearing because of a paperwork deadline is still devastating. And here's a small silver lining. If you catch the mistake and fix it quickly, within what's called the correction window, the penalty can drop even further, down to 10%, but you have to act fast, and you have to know the mistake happened in the first place. This is where most people get blindsided. They don't get a warning. They don't get a friendly reminder from their bank. The account custodian might send you a notice, but many don't, especially with smaller institutions or old accounts you've forgotten about. If you have retirement money spread across several old jobs in several different accounts, this becomes even more complicated. It's shockingly easy to miss one account entirely. Let's move to the next major point, because this is where the real complexity lives. That first year extension I mentioned, the one where you can wait until April 1st instead of December 31st, actually creates a hidden problem. If you delay your first withdrawal into that following year, you still have to take your second required withdrawal by December 31st of that same year. That means you could end up taking 2 full withdrawals in 1 calendar year. 2 withdrawals means 2 chunks of taxable income landing in the same tax year. For some people, this pushes them into a higher tax bracket. It can also affect how much of your Social Security becomes taxable. It can even increase your Medicare premiums the following year, because those premiums are based on your income from 2 years prior. So that convenient extension everyone assumes is helpful, for a lot of retirees, it actually creates a bigger tax bill than if they'd just taken the money on time in the first place. This is the counterintuitive twist I mentioned earlier, and it's the reason so many financial advisors actually recommend taking your very first RMD in the same year you turn 73, rather than waiting for that extra few months. Waiting can feel safer, but mathematically, it often costs you more. Let's talk about how these withdrawal amounts are actually calculated, because this isn't just a flat percentage. The IRS uses your account balance from December 31st of the previous year and divides it by a life expectancy factor from an IRS table. As you get older, that factor shrinks, which means the required percentage you must withdraw actually increases each year. This isn't a one-time event. It's a recurring, growing obligation for the rest of your life. And if you have multiple IRAs, you can add up the total requirement and take it from just one account if that's easier. But if you have multiple 401k accounts from different employers, that rule doesn't apply the same way. Each 401k typically requires its own separate withdrawal. Mixing these up is one of the most common and costly errors people make. Now let's talk about protecting yourself, because this is the part that actually matters. First, figure out every single retirement account you own. Old 401ks from jobs you left 15 years ago count. Small IRAs you forgot existed count. Write them all down. Second, mark your calendar, not just for December 31st, but for well before that, so you have time to fix any mistakes. Waiting until the last week of December is how good people end up with bad surprises. Third, if this is your first required withdrawal year, sit down and actually calculate whether taking it this year or waiting until April of next year saves you more in taxes. Don't just assume the delay is the better option. Run the numbers or have someone run them for you. Fourth, if you're using multiple IRA accounts, remember you can combine the requirement and withdraw from just one, but 401k accounts almost always need individual withdrawals. And fifth, if you ever discover you missed a deadline, don't panic and don't hide from it. Contact a tax professional immediately. That correction window I mentioned, where the penalty can drop from 25% down to 10%, only works if you act quickly and file the right paperwork. I want to pause here and say something important. If you're watching this and feeling a little anxious, that's a completely normal reaction. This system is confusing on purpose, in the sense that no one sends you a clear, simple reminder. It's scattered across different institutions, different account types, and different deadlines. You are not careless for not knowing this. Most people don't know this until it becomes a problem. The fact that you're paying attention right now, before it becomes a problem for you, means you're already ahead of where most people are. Let's bring this all together. Turning 73 means your required withdrawals begin. You technically have until April 1st of the following year for your very first one, but taking it in the same year often saves you money because it avoids stacking two withdrawals into one tax year. Missing a deadline entirely can cost you 25% of the required amount, though that penalty can shrink to 10% if you correct it quickly. The withdrawal amount is recalculated every single year based on your account balance and your age, so it's not something you set once and forget. And finally, IRA accounts can often be combined for withdrawal purposes, but 401k accounts usually cannot, which is one of the most overlooked details in this entire process. If there's one thing I want you to take away from this video, it's this. This isn't about scaring you. It's about making sure a rule that quietly costs people thousands of dollars every single year doesn't catch you off guard. The people who avoid this penalty aren't smarter than everyone else, they just knew about it in time. So here's what I want from you. In the comments below, tell me if this is the first time you're hearing about this rule, or if you've already gone through your first required withdrawal yourself. I want to know what your experience was like, whether it was smooth or whether you ran into surprises along the way. Your comment might be exactly what someone else needs to read before they make the same mistake. If this video helped make something confusing feel a little clearer, consider subscribing, because I break down rules like this one regularly, the ones that quietly affect your money without ever making headlines. Take care of yourself, take care of your money, and I'll see you in the next one.